FAR.F5.M6.
Income taxes. 2 sets of rules enter, 1 journal entry leaves.
More accurately, Russell, financial accounting follows GAAP and the tax return follows tax law. The same transaction can be recognized differently under those 2 rule books.
So, picture 2 scorekeepers. Book accounting tracks the economic game. Tax accounting tracks what tax law counts this year.
Your first question is whether their disagreement is permanent or temporary. A permanent difference never reverses. A temporary difference is a timing difference that will reverse in a future period.
Permanent is a tattoo. Temporary is a delayed text.
And only temporary differences create deferred tax assets or deferred tax liabilities.
Now the big picture. Total income tax expense has a current component and a deferred component.
Current tax expense is taxable income from the tax return multiplied by the applicable current tax rate. The basic entry debits current tax expense and credits income taxes payable. The exam generally ignores estimated tax payments unless it specifically gives them to you.
Deferred tax accounting asks a different question. What future tax consequence exists because book and tax recognize something in different periods?
At year-end, determine the required deferred tax balances. Then compare them with the beginning balances. The change produces deferred tax expense or a deferred tax benefit.
The balance sheet tells you where the account must land. The income statement records how far it traveled.
That is the key operating model.
Let's clear out permanent differences first. Tax-exempt interest on municipal bonds is book revenue, but it is excluded from taxable income.
Because that exclusion never reverses, it creates no deferred tax liability. Another textbook example is life insurance premiums when the corporation is the beneficiary. The premiums may reduce book income without being deductible for tax, but they do not create a deferred tax asset.
So, a permanent difference can change taxable income and the effective tax rate, but it leaves no deferred tax account behind.
Exactly. That is why the shortcut book income greater than taxable income equals DTL can be dangerous. First, prove that the difference is temporary.
Suppose pre-tax book income is $100,000, including $10,000 of tax-exempt municipal bond interest. At a 30% tax rate, taxable income is $90,000 and current tax expense is $27,000.
There is no deferred component because the difference is permanent. Total tax expense is also $27,000.
Now, temporary differences. Forget memorized arrows for a moment and ask one question. When this difference reverses, will the company pay more tax or save tax?
More tax later means a deferred tax liability. A future deduction or other tax benefit means a deferred tax asset.
Here are the 4 timing patterns. Book revenue now and taxable revenue later means tax was postponed. That creates a DTL.
Taxable revenue now and book revenue later means tax was paid early. That creates a DTA.
Book expense now and tax deduction later means the company is waiting for a deduction. DTA.
Tax deduction now and book expense later means the tax benefit arrived early, leaving more tax for the future. DTL.
So, tax paid early is usually an asset. Tax postponed is usually a liability.
Useful, but only for temporary differences. A permanent exclusion may reduce current tax without creating any future liability.
Classic DDL example. Books use straight-line depreciation, while tax uses accelerated depreciation such as MACRS. Early on, tax depreciation is larger.
That larger tax deduction makes taxable income lower than book income today. The company pays less tax now, but tax has used more of the total depreciation deduction.
Later, tax depreciation falls below book depreciation, taxable income rises, and the company pays more tax. That future tax cost is a DTL.
Suppose tax depreciation exceeds book depreciation by $20,000 and the enacted reversal rate is 30%. The required DTL is $6,000, assuming no prior balance.
Current tax expense is lower because taxable income is lower. The $6,000 increase in the DTL creates deferred tax expense.
Now the classic DTA. GAAP records an estimated warranty expense today, but tax law allows the deduction when the warranty claims are paid.
Book expense now, tax deduction later.
If the temporary difference is $10,000 and the enacted rate is 30%, the company records a $3,000 DTA. The future deduction is the benefit represented by that asset.
An increase in a DTA creates a deferred tax benefit. An increase in a DTL creates deferred tax expense.
The debit and credit pattern confirms the logic. A DTA has a debit balance. A DTL has a credit balance. But determine the future consequence before reaching for the journal entry.
Bad debt expense can follow the same DTA pattern when book accounting recognizes an estimated loss before tax permits the deduction.
Correct. Estimated liabilities and expenses often create future deductions because book recognition occurs first.
Revenue can work in either direction. If tax collects its share before GAAP recognizes the revenue, the company has paid tax early.
That generally creates a DTA. If GAAP recognizes revenue before tax law taxes it, the company pays later, creating a DTL.
Candidates love the shortcut. Temporary book income above taxable income suggests a DTL. Temporary taxable income above book income suggests a DTA.
Use it only as a check. Permanent differences and multiple offsetting items can break the shortcut. Classify each item separately.
Questions may also give book basis and tax basis instead of income amounts.
Then return to reversal logic. If recovering an asset's book carrying amount will create future taxable income because its tax basis is lower, the result is generally a DTL. A liability recorded for books but deductible when paid generally creates a future deduction and a DTA.
Future taxable amount liability. Future deductible amount asset. That survives more fact patterns than a pile of arrows.
Now remember that deferred taxes are ending balance calculations. Suppose the beginning DTL is $4,000 and the required ending DTL is $7,000.
Increase the liability by $3,000. The $3,000 change is deferred tax expense. $7,000 is the ending balance, not the current year expense.
If the required DTL instead falls from $7,000 to $5,000, the $2,000 decrease creates a deferred tax benefit.
Same approach for a DTA and for a valuation allowance. Find the required ending balance, compare it with the beginning balance, and record the change.
Deferred balances use the enacted tax rate expected to apply when the temporary difference reverses.
Not a proposed rate, not a rumored rate. Not a rate some senator mentioned while sprinting through an airport.
Only an enacted rate. If a $30,000 difference will reverse when an enacted 25% rate applies, the deferred amount is $7,500, even if today's rate is 30%.
Current tax uses the rate for the current return. Deferred tax uses the enacted rate for the expected reversal period. Different questions, different rates.
Now the valuation allowance. A DTA represents a future tax benefit, but the company may not be able to realize all of it.
If realization of some portion is not more likely than not, meaning not greater than 50% likely, record a valuation allowance.
The allowance is a contra asset that reduces the DTA to the amount expected to be realized. Suppose the gross DTA is $20,000, but only $12,000 is expected to be realized. The required valuation allowance is $8,000.
An increase in the valuation allowance increases income tax expense because it reduces the recognized tax benefit.
And once again, use the change in the allowance, not automatically the full ending balance.
Let's combine the rules. Pre-tax financial income is $100,000. It includes $10,000 of tax-exempt municipal bond interest and $10,000 of warranty expense that will be deductible later. Assume a 30% rate and no beginning deferred balances.
The municipal bond interest is permanent, so subtract it when reconciling to taxable income but create no deferred account. The warranty expense is temporary, so add it back because it is not deductible yet.
The two adjustments offset. Taxable income remains $100,000, making current tax expense $30,000.
The warranty difference creates a $3,000 DTA and therefore a $3,000 deferred tax benefit. Total income tax expense is $27,000.
Conceptually, Debit income tax expense for $27,000. Debit the DTA for $3,000, and credit income taxes payable for $30,000.
The payable reflects the current tax return. The DTA reflects the future deduction. Income tax expense combines the current and deferred effects.
Notice the trap. Taxable income ended up equal to book income, but the company still had both a permanent difference and a temporary difference.
That is why each difference must be classified rather than merely netted together.
Exam day sequence. First, separate permanent differences from temporary differences.
Second, exclude permanent differences from the deferred tax calculation.
Third, ask whether each temporary difference creates future taxable income or a future deduction.
Future taxable income means DTL. Future deduction means DTA.
Fourth, apply the enacted rate expected when the difference reverses.
Fifth, determine the required ending DTA, DTL, and valuation allowance balances.
Sixth, compare those ending balances with the beginning balances to find deferred tax expense or benefit.
Finally, calculate current tax expense from taxable income and combine the current and deferred components.
My closing analogy. Current tax expense is today's bill. A DTL is a tab for tax benefits received early. A DTA is a future discount earned by paying tax early.
And the valuation allowance asks whether that future discount will realistically be usable.
Permanent differences never reverse and never create deferred taxes.
Temporary differences reverse. More tax later creates a liability. A future deduction creates an asset.
Current tax comes from the current return.
Deferred tax comes from changes in the required balance sheet amounts.
Use enacted reversal rates, evaluate the DTA for a valuation allowance, and do not let a permanent difference sneak into your deferred schedule, wearing a fake mustache.
That image is ridiculous, Russell.
But memorable.
Temporarily.